Hi traders, welcome to Elite Currency. Thanks for joining us in this live webinar. Once a month, Nennet and I both take a look at new topics, things that we would like to share and explain or discuss. So my pick for today is basically looking at the market structure in a deeper way. It's not maybe everyone's cup of tea, but I think it's something good to think about in a deeper way than just looking at charts and technical analysis. But what are we really analyzing, and why is price moving as it moves? Why do we see all these ups and downs? So I guess there are a lot of theories about that, but I'm going to share some thoughts about the deeper market structure, and we'll dive into fractals, chaos theory, etc. So if you could confirm that you hear me, I'll continue with the next slides. If you can hear and see me, that would be great. Just as a double confirmation. Awesome. Perfect. So feel free to reach out with questions through the chat. In the same way, I'll be checking, once in a while, here and there, if you have any. So today we're going to take a look basically at identifying swings, because that's really an important part of understanding the momentum and correction and gravity, energy in the market. We'll connect that to fractals and chaos theory, how patterns are very important, and how they can sometimes fail and confirm, and what kind of probability is connected to that, and then finding trade setups. So that's what we're going to discuss today. So first of all, finding and understanding, identifying swings, I think, is a very important part, not only for wave analysis, basically, because of course, wave patterns, wave analysis is nothing more or nothing less than labeling these swings, right? And that sounds fancy for traders that don't understand or are new to wave analysis. Perhaps you see all these letters and numbers attached to these movements, and that might seem complicated at the beginning, but it's really not that. The theory itself is not that complicated. It's just attaching these symbols to swings, price swings. The price swing has a start and has an end. The real trick is understanding what is one swing and having a systematic way for understanding those swings, a method that is same day in and day out, and that makes you confident in how you approach and analyze the market. Because if you don't have that, then you're always second guessing yourself. Is this a move? Is this a move? And where does that start and end? Then it makes it more difficult. But if you have a mathematical or a structural approach to that, then labeling is just like an extra, and in that regard, it's not that more difficult to add letters and numbers to it. All right, and in any case, adding those letters and numbers are, in my opinion, just like an extra, just like a confirmation, but it's not really a key. The key thing is finding those swings. And if you use wave analysis or not is up to you. Everyone has their own opinion on that, but understanding swings, finding swings, I think is important for all traders, regardless if you're a wave expert or just starting with waves, right? This is key for everyone. So how do we find swings? We use basically a couple of different methods, and sometimes one is more important than the other, but these are our main four tools. So fractals, the oscillator, understanding just the principle of momentum and correction, and the HMA. This is something that we actually dive into our own SWOT course, which is simple wave analysis and trading. It's more than wave analysis. It's basically trading market structure, but with more emphasis on waves. And this is what we teach there, but we're going to dive into like a more deeper topic of the market structure. So here you can see fractals. So for instance, at the top, you'll see resistance fractals, and as price falls, you'll see not as many fractals perhaps as a correction, although here we see a few of them indicating some smaller pauses within this downtrend. So, as soon as you see fractals, that is a warning that price is either stalling or making consolidation. And once price breaks through that fractal, we might get a continuation of that momentum. So in this case, we have bearish momentum. That is very well, you can see, indicated by our ECS candles. So the candles indicate momentum, and the fractals indicate, okay, there could be a pause. But when price breaks through those fractals, then we know the swing is continuing. So it's kind of a natural flow by using candles and fractals. If we get fractals on the opposite side of the moving average, because you can see here fractals below the 21 EMA, those are not that important. That's why the fractal color is a light tint of green. But once it breaks above the 21 EMA, or it's at the 144 EMA, the fractals become darker in their color because that is becoming a key fractal. If price breaks above that, then you're looking at a bigger corrective swing. The darker red fractals in this case, because it's a downtrend, indicate full steam ahead, full momentum swing to the downside. So we have our own fractal that we use for identifying, one swing. So this is all downtrend is all one swing. This is a hefty correction. It's one swing. This is again downtrend because the fractals are below the 21 moving average, and we have red fractals. So it's all one piece. Okay. Here we see price breaking above these dark blue fractals. So that's indicating a bigger correction. So this is a three-wave correction to the upside, and price is above the 21 EMA. So using moving average, fractals, and these candles, we can assess, okay, this was one swing, price was below the 21 EMA, this is a correction, this is another swing, and this is a bigger correction where price goes back to the 144 EMA. Very sweet, very simple. We understand what are the swing points here on the chart. We can use basically just correction, right? Concepts, for instance, momentum. We'll see one directional candles. We'll see a majority of candles basically push in one direction. That means like 70% of the candles are bearish. The majority of the bearish candles are, we're not majority, but there are many candles that are strong, big, sizable bearish candles. For instance, here and here. All right. So the momentum candles are typically bigger, and the candle closes are near the low. So that's indication of momentum. That's a confirmation of momentum. Sizable candles, big candles, sizable candles, candles close near the low, and the majority are, in this case, bearish. That's bearish momentum. Opposite, of course, for bullish momentum. Corrective candles are small, choppy, up and down, closes not near the high, etc. So here, for instance, in this piece down below, those are typical corrective kind of candles. Here too. Here you can see just a blank chart without any moving averages. We use the moving averages, as I already explained, to understand the market structure in a deeper way, because it gives us an idea about those swings, as I just explained, right? That this is one swing, this is a corrective swing, this is a bearish impulsive swing, this is a bullish corrective swing, this is a bearish impulsive swing, right? So it gives us kind of it's like a road map, or it's like a sign when you're driving on the highway and you see a sign, 5 kilometers before the next exit. So the same moving averages is giving us that similar kind of information. Without it, you would understand momentum and correction, but you wouldn't really have the same kind of idea about the situation, the current kind of market structure that's going on. Is this a big correction, small correction? You would still, generally speaking, you could still use the concepts of momentum and correction, because look, here you can see strong momentum. As you can see, majority of these candles are bearish. Majority of these candles that are bearish are pretty sizable. And most of these closes are near the low. And the few bullish candles are small, insignificant, and more or less choppy. So you can always use, even if you don't like moving averages, even if you think that this is not useful info for you, you can still always use, I think, the pure momentum and correction kind of concepts, right? And here you can see corrective oscillating price sideways, smaller candles, mixture of candles, closes, not always near the high or low, more mixture as well, typically. And you can see that in this piece. So we use the moving averages as a roadmap to understand where price is going. But if you don't want to use that, you can always use the momentum and correction on a blank chart, just like that. We like the HMA as well. And we basically use that as a momentum kind of indication. And as you can see, if you're not sure about the momentum, if you're maybe just starting out with, for instance, understanding momentum correction, HMA will help, because if it's one directional like this for a while, then that is, already here, a few candles like that, that's typically good bearish momentum. So that's a very good tool for understanding momentum as well. And I forgot the awesome oscillator, but the awesome oscillator basically, or the MACD, we can use the MACD instead. It indicates when the swing starts and when the swing ends. So for instance, when price is at the zero line, and you see, or not price, I mean the MACD bars are at the zero line, you see it move away from the zero line and then back to the zero line. So when it starts and goes back to the zero line, that's often one swing. And you can see that the MACD bars are around the zero line. That's indicating oscillation, it's indicating correction. Same thing with the awesome oscillator. So you can use that for understanding what is one swing. AO bars starting at the middle line, zero line, going back to the zero line. That's one swing. So those are some very quick 12-minute introduction to understanding swings. But now that we know swings, this takes maybe some practice, of course, but let's move on. And so we know what is a swing, but we need, the next step is to identify, is that swing a momentum? Is it corrective? I already indicated what that was, right? So we won't dive into that now too long, but with these tools in mind, we can know when the swing starts, we know when the swing roughly ends, and we know whether that was corrective or that was impulsive. So this is already a ton of info. And if you know this, and if you practice this, you're already ahead of the field, pretty largely, I think, because not many traders look at this. I think just looking at, just a couple of maybe tools that they know, but I think that this gives a deeper kind of view of things. And if you want to, only if you want to, then you can start looking at labeling waves. Only then. Many traders, I guess, start labeling right away. They read a little bit about Elliott wave. They think, all right, that's great. I'm going to start right now, label waves. It doesn't work. They give up. They move on. Rather than doing that, start with swings, momentum and correction. And then if you think that you're confident that you have practiced that enough, you can think about adding wave labeling and invalidations and levels that and the entire kind of Elliott wave theory, if you want to. If not, that's also fine. But these two concepts are already very useful. Now, why do these swings repeat? Why do we see momentum and correction all the time reoccurring? That's because the market is fractal of nature. So maybe you've heard of that already before. Fractal indicates that we see the same pattern repeat on different time frames. And we see the patterns repeat throughout history as well. So these are repetitive patterns. Momentum and corrective patterns repeat. Therefore, chart patterns repeat. Therefore, candlestick patterns repeat. So it is, every piece of the chart is unique, right? But they're also, in many ways, very similar to what we've seen in the past. And because these patterns repeat in a good number of cases, we can analyze that and use that info to try to get a benefit from that in the now, right, and the future. So because the chart is not really a mathematical object, it is not a square, it is not a circle, not a rectangle, right? You see price going up, down, impulsive, corrective. it's chaotic, isn't it? In a way, if you look at it, right? Many traders think it's chaos. They don't understand. They see at the beginning, they see this chart full of things, and it could fly up and down, and they have no idea why. So to anyone who's starting out, it seems very chaotic. And fractal is actually part of the chaos theory that explains that there are many things in our world, ranging from weather patterns to nature objects like the shore, to music notes that are fractal. And for instance, the weather could be seems chaotic, seems at random, but there's actually more. There is more pattern to it. There's more of a structure to it than we think. Although it's called chaos theory, it actually indicates that things that seem chaotic are actually, we are way more better to understand them and the patterns than we might imagine. Weather, as I already mentioned, is the same thing. There are actually patterns that play out, and nowadays weather forecasts are very accurate, up to 7 days into the future. After that, it breaks down because there are too many factors to consider. There are too many elements that could change within those 7 days that would, basically reduce the ability to look beyond 7 days. Too many factors. So the same is for the markets. We can look up to we can make a reasonable forecast up to a certain moment, but then we don't know how it will look after that, because there are so many things that can happen in between now and then that is difficult to look that far. So chaos theory basically gives us the theoretical framework to understand why we can tackle the charts the way we do. It's not a mathematical thing. It is chaotic, and we can understand the chaos by using patterns. That is basically what this theory is saying. So let me check if there are any. No questions. Great. Everything is clear, hopefully, but not, let me know. So here's an example of a chart, finally. So this might seem chaotic for anyone who doesn't understand these patterns. But once you understand simple momentum and correction already, you can see the chart in a different light. Look at the purple boxes indicating consolidations. Look at the arrows indicating momentum. So that already gives us a totally different understanding, doesn't it? We see consolidation and break above the consolidation, and we see bullish momentum start. We see then consolidation, momentum, consolidation, momentum, consolidation, momentum, consolidation, and we see an opposite momentum occur, right? Much easier to understand the charts, and by understanding these patterns, we have a better idea about what could happen in the near future. Of course, would I know that price is around here, right? Around 110, 109 on the somewhere in spring, in May this year. Would I know that 4 years ago? No, it's too far ahead. I would not know that price would go up first, then down like this, and then up. But you cannot look that much. But it does give a reasonable idea about the near future, and the near future depends on the time frame you're looking at. For a weekly chart, the near future, I think, is anything in between anything between 5 and 25 candles is typically something that we have a good idea about, right? But more than 25 is already getting a little bit more difficult. I think 50, 100, you're really looking very far ahead, right? So in weekly, that would be weekly candles, right? So we're talking about up to half a year, okay, but more, it's a little bit difficult because who knows what happens in that year, right? And then based on that, many things can change. And as you can see, the fractal, the charts are fractal of nature, but we also use a fractal indicator, which is a bit different. Fractal is the concept, and the indicator is kind of a tool based on the fractal concept. And you can see that that helps us indicate those break spots, the momentum direction, because we have the diamonds indicating an uptrend here. All right, so HMA would help, and the Oscillator will all help indicate that this is a swing that is a swing, etc. But just looking at momentum and correction, you would see that too. So now the next step, now that we know that we have these patterns, and these patterns are very important because we can understand the market structure in a very deep way with these patterns, right? And these waves as well, and that they repeat on all time frames and throughout history, and the charts are fractal. So now everything is kind of like getting a different dimension, isn't it? Because maybe you were only looking at support and resistance in the past, but what does price do at support and resistance, right? What would you expect at those levels? And maybe some support and resistance traders don't care. And I think, by the way, that support and resistance is very useful, but within the context of together with trend and patterns. So there's a kind of a triangle of analysis, patterns, price patterns, basically. Number one, support and resistance, and then trend and momentum. They're all three very important. But patterns, to a certain degree, are the concept that give you, I think, a deeper look, a deeper understanding of the market structure. So this is something I'm running a little bit ahead of my own presentation, but here you can see, by the way, the fractal nature of a formation like this. So, the self-repetitive forms that you would see in the image. So this is also a little bit connected to your belief system, right? Do you think that the market is fractal, and does it move according to the chaotic kind of chaos principle theory, or do you think it behaves because of something else? That would be important, because if you think that this is blah blah, then obviously you should use probably some other tools, because you're never going to use it in a way that will help you. Because if unconsciously, subconsciously, you think that this is not the way to look at the markets, then it's better to find something that suits you, that is in line with how you think the markets do move. All right, but to recap, basically, the chaos theory says that the markets, because it's not a mathematical object, but it's a random kind of event that is predictable, and we can understand that through patterns. That's the main message. Now, these patterns, they create basically a path for price to walk on. And here you can see how easily you could imagine almost the flow of price being very similar to this path. So these patterns, they create kind of a path, and we can analyze that path, and we can then try to estimate and predict and forecast what that path could be in the near future. How would that path look like? What is the chance that price will walk this particular path in the next candles? Based on previous patterns, based on historical patterns, based on patterns we see right now, we can make that assessment and make that judgment. So basically, by using those patterns, we can analyze the past path of least resistance, and try to make an estimate of how that would look like in the near future. So, for instance, if the euro dollar is showing a strong uptrend, and it's making a bull flag chart pattern, and there's no substantial resistance levels in the way, and it breaks that bull flag, what would be the path of least resistance in this case? Probably a continuation higher, a continuation with the trend, considering the fact that the bull flag was broken. So that is basically understanding what is the path of least resistance. So when you look at my wave charts with Elite CurrenSea, you will see what I think is the most likely path. So here is an example of the dollar yen 1 hour chart. One where we were looking at the 8th of May on the left, 8th of June, and on the right, the 12th of June. So 8th of June, here, just to give you an idea, I am labeling the waves. This is not something you have to do. I don't think you have to necessarily label it to use these concepts, but you can, of course, and I do that because I like the concepts. It helps me understand the market structure in a deeper way. So I labeled it with an ABC at that time, and indicating that there was an end of a corrective formation, and I was expecting a wave X down and a bounce at these fibs for another corrective wave to the upside, a purple wave Y, because that's the pattern. A WXY is a complex correction where you have typically an ABC in these W and X and the Y. So at this point, I marked it as completed W, or you could even say a completed A. I think I have made it today, but it really doesn't matter that much in my view whether this is A or W. Some are very precise in this, and that's fine. I'm a little bit maybe less precise. I just want to understand the general flow of the charts. So I was expecting the price will be in this channel and get down to the 50 or 61.8 fib, that this upside is not uptrend continuation because it broke the rising wedge chart pattern. As you can see, look at the orange and the dotted green, which was the kind of signal that the W purple was finished. We had an ABC pattern, but I didn't think the green ABC correction to the downside. I didn't think that that was the end of that bearish correction. I expected one more leg down. That's why I marked this blue X. The confirmation of the downside is with the break below the green line here. And I didn't expect price to go below the 50 and the 61.8 fib. It break below that would not necessarily invalidate it, but would maybe, let's say, make this wave analysis a little bit less likely. The odds could change, the probability could change. The confirmation that the purple X is finished would be when price gets into this zone, or if price breaks above the resistance trend line, the red trend line there. So using these tools, we understand how to measure basically this path of least resistance, right? We can use tools like fibs, moving averages, trend lines. And these are great tools, but if you maybe don't know what they represent, they'll be maybe less valuable. If you understand that we're using them to measure the path of least resistance, right, based on patterns, you will understand the deeper meaning of them. So when price then, as you can see in the right, broke the green line, fell down, hit the 50, 61.8 fib area, then broke above the red dotted line, we had several confirmations. We had not only the confirmation, as I already just explained, that the wave W purple was finished, but that the wave X was finished, has been finished, and that Y has started and is on its, probably at this point, maybe still on its way because it's still in between these purple trend lines. And it hasn't hit maybe the bigger resistance spot up in here. All right, so this is how you can make these assessments about the path of least resistance, which is based on patterns. You can make this assessment based on all these tools. Alrighty. So now, once we have the tools, we know basically how to measure the path of least resistance. And you don't have to use these tools specifically. You know, traders, I use these tools. I use ECS SWOT tools, what I explained in our course. And ECS SWOT is not only a course where we have videos, but it's also actually a software package with indicators, and it's a method with systems built in it, trading systems. So it's a course, it's trading systems, and it's also the software to trade those systems, right? So it's three things in one, really. So once you have so what we do is once we know, okay, we have patterns, right? Path of least resistance, and we have tools. You don't have to use these tools necessarily. You can use your own tools. But the point is that once you have a path, you need to measure it. Is it invalidated or confirmed? And would you want to trade it using your tools, right? Candlestick patterns, etc. Everything. What you, we have our tools, the ECS candles, fibs, moving averages, right? You can use others. Once you have that, you'll find eventually, obviously, then the trade ideas, right? That are connected to the invalidation confirmation levels of that path. The thing is that we have to keep in mind is that every setup at that point is a probability. Nothing is, despite our best attempt to understand the market structure, it's never a guarantee. The market is like the wind. We cannot catch it, or we cannot, like, we can try to forecast and predict it, but things can change. With weather forecast, there's maybe a 50-50 chance of rain. Then maybe the butterfly that you've probably heard of somewhere in Brazil that spreads its wing could create that thunderstorm. We don't know what kind of factors change things and make something happen or not, right? So it's always a probability, and this is something we need to accept and realize and really fully embrace, that despite our best attempts to analyze, it is always still a probability. Now, in the long run, after 40, 50 trades, obviously we need to see a positive equity curve in the long run. Those few losses don't matter. One trade setup is nothing. Even a few trade setups is nothing, because these are small streaks that always can happen. We always have to keep an eye on 50 trades. Set of 50 trades. That's where you want to see long-term profitability. And if you don't, then you want to analyze why. Were you unlucky? Or how much loss was it? Or did you make profit? And after 50 trades, you should see that on average, most of the time, because that's a decent series of trades, long enough, to kind of remove those incidental losses where everyone will run into. It's enough trades to prove that your analysis or your method or your system is doing the right thing, right? One trade never means anything. It's always a probability. That time when the trade is triggered, it might look good. It might seem like high probable, but then we get new info. We get new candles, just like the weather forecast predicted maybe 5 days from now, sun. 3 days from now, they might predict half sun and half clouds or rain, right? Those things can change. The markets are the same. When we get new info, the probabilities, the pattern, the path of least resistance can change too, and therefore the probability of our setup as well. All right. Wave function collapse is something that where patterns basically break down or change, right? So it's the same in the markets. A bull flag, like we had on the euro dollar pound dollar today. I actually had a video this morning that I was bearish, very bearish on these, but because the bull flag pattern had lasted so long, even after dollar interest rate hike, I started to switch my vision and say, okay, it's probably going to break, pull back, and continue. It did break, it did pull back, but it didn't continue, right? So there was a breakdown, a kind of a wave function collapse as part of quantum physics, where patterns, basically emerge in a different pattern, where patterns kind of break down and reemerge in a different way. So now I'm not an expert on this quantum physics stuff, but I just wanted to give you the term so you can always look it up yourself. I might not be that precise in explaining it, but basically patterns can not develop as you've originally thought, and that new info will give us kind of a insight in that. So when you trade a set and forgets system, that's okay. There's nothing wrong with that, but you are kind of forgiving or giving up the possibility of using new info to the benefit of understanding the path in a better way. Because if you don't use the new info, you're not updating what you think is the most likely path of least resistance. So active trade management, I think, is better, because then you're able to use that info. The problem is that you need experience to be able to handle that new info. Because if you are using an active trade management and you're getting all this info, but you're not using it in the right way, you're overemphasizing it, or you're not using it enough, then you're going to run into some problems. Set and forget, you don't have that problem because you just took the original trade. All these candles appear, but you don't use it. So it's kind of info that you don't use. The path of least resistance looks totally different 10 candles from now. But you still don't use that. You still hang on to that original setup. It's good for beginners, let's say, or traders with less experience because they don't know how to use that new info. But once you do know how to use that new info, and active trade management will allow you to update your expected path of least resistance, update what you think your setup has as a probability, and then whether it's still desirable to stay in or not, depending on whether the patterns are looking still good or not, whether the path is still looking desirable or not. So one more thing about probability is the taking into account the fact that how to handle these new info, right? So what often happens is that with probability, humans are not very used to probabilistic thinking. That's just a standard kind of way of looking at it. We're way more risk averse when we're in profit. We're way more willing to risk when we're in loss. So that's already kind of a mindset issue, flaw in a way from us, right? So that is weird in a way. I mean, it happens. It's just part of us, humans. But if you look at it from a probabilistic point of view, it doesn't make sense, right? If you're risking 50 euros, whether it's profit or loss, it's 50 euros in both, in both cases, right? So we're kind of skewed with this. So we have to we're also biased in the sense that new information, we often emphasize the new information more. We over kind of rely on that, or we under rely on that. So it's very difficult for us to balance that new information. So that's why active trade management is quite difficult for traders, because we are skewed to overreacting or underreacting. So that's just a quick heads up about probability. It's difficult for us to assess probabilities in general. That's why we are way more inclined to listen to someone who's very sure about an opinion rather to listen than someone who says that there's a 60-40 chance of something. It's not interesting to us. It doesn't trigger some emotions in us or something like that. For TV, it's way more interesting to have someone who is 100% sure about something. But because we're just not good in assessing 60-40 and 70-30 and all these kind of probabilities around that. Very difficult for us to judge and handle that information. And that's regardless of education, IQ, it's across the board. So active trade management is a separate topic. We have a separate webinars on that. You can find it on the Elite CurrenSea YouTube channel. So with regard to trading bias, so there's a little bit of a connect here. When identifying and looking at patterns, keep in mind that this will create a certain bias in us, because the pattern itself leans towards, once we identify that, kind of suggests something. So when we understand how those patterns develop, we expect that to develop in a similar way in some cases, right? So that creates a trading bias. And that is good. There's nothing wrong with that. Trading bias is actually useful because it gives us the confidence to enter a trade and live through that trade. If we don't have any bias, if we don't have any confidence in the trade, we'll just get scared and fearful of small whipsaws, and we will be very difficult position to stay in a trade until the target or until the trade plan is completed. So this bias, in a way, is good because it gives us the analysis and the proper confidence to have it. Bias is not so useful if you're starting out and you see price quickly move up, and based on that you take a trade decision. That's more reacting on your own feeling, or you're fearful of something because of some, you see something in the chart and you're fearful of it. So this is Bias is based on emotions, which does not help our trading. Bias is based on patterns and understanding and identifying these patterns. That is something that is most of the time useful. But of course, even then, it is good to measure how good these trades are. Once again, in the long run, once again, over 50 trades. But generally speaking, don't be worried that these patterns, the path of least resistance, create a certain bias in you, what you expect. So when you see, for instance, price, you make your analysis, you see the path, you see the patterns, you use your tools. And so don't be surprised that that creates a certain bias in you. Everyone has a bias. If you're trading, you need to have a bias. Every time you enter, you must have bias, because you have, that's the whole thing of trading. You think it's going up. Why else would you buy it, right? There's no other reason why you would do it. Otherwise, you'd stay out of the market if you have no bias, right? But the bias is important, that it's based on, I think, solid things, not emotions. That's basically the point. And once we're in the trade, don't let the bias don't let it hinder your rational analysis of the path and the patterns that you see evolve, because that happens often, is that once you enter, you cling to your side and you kind of wishful thinking and hope, kind of ignore the signals and the developments that might be warning you that your trade is not developing as it should, and you kind of ignore that picture. That often happens too. It's like, you get those pink glasses on. So yeah, this was market structure within 45 minutes, plus minus. The SWOT is based on this market structure, but we are showing it in a simple way with a simple course. Then later on, we add some extra things that are maybe more deep, but only for those that like it. Simple method that shows how to trade the patterns, basically based on our software, and fibs, moving averages. Wave patterns, yes, they are complicated because they do break down, they do change. That's why we don't emphasize the wave patterns necessarily with SWOT, although it's called simple wave analysis and trading. It's more about effectively trading patterns, and the SWOT system and software simplifies that process. All right. So, and basically the ECS candles you saw and the moving averages, that's all part of that, part of the simplification. So yes, so summary: fractal markets are fractal. They seem random, but there's actually predictability in that randomness that we can analyze through patterns, and we can then assess the path of least resistance. And we, by analyzing impulse and correction, can understand the patterns and the path better. We can then set up invalidation and confirmation points using basically tools, your tools, or ECS SWOT tools, or Nenet's tools to confirm that. And then you can take the trade. And then there's the probability of trades that can change. And then you have to manage that trading bias. And that's it. You have the energy in the market, energy and gravity when price is going away from moving averages, and the gravity when price goes back to moving averages. That's momentum, and correction is based on that. And you have those patterns that break down and correct. But the core of it is really that we can predict or understand the markets through patterns, which are based on impulse and correction, which leads us to understand the path better. And then we can set up our trading plan based on that path and using those tools. That's the core. That's the summary, in my view, at least. If you are interested in our Traders Club, we mentioned it last month, but just a quick reminder here at the very end. Feel free to check it out. Maybe some more options for you there now. CurrenSea.com, trusted brokers. On our website, not only a way to get some of our methods for discount, but also we have free analysis, of course, regularly updated every day, and we have our ECS start package. So Up to you. If you're here for the first time, try out ECS Start Package. If you already have the Start Package, maybe check out our analysis in more detail or this ECS Traders Club. If you have any questions, please feel free to do that now. Otherwise, I'll be closing the webinar more or less pretty soon. But I haven't seen any questions so far, so that's good. But you can always reach out to us through these tools here. You can go to our website, go to our email, go to Twitter. And if you're watching the recording later on, which will be added to YouTube, you can, we would, of course, be very grateful for your share, like, or subscribe. No questions. Well, if you have any questions, feel free to use those tools that I just already, or sorry, these contact methods. I hope it gives you, not only a theoretical angle, but also helps you make the practical decisions in a more confident, in a better way, because you understand kind of maybe more concepts now, at least how I look at the market. And everyone has their own view how the market works, but this is what I think is making the price tick. So, well, thanks for being here in any case. I hope it helps, and wish you all good trading. See you soon. Cheers.